What are the top money market funds at Fidelity, Schwab, and Vanguard paying at the moment? And why are we pulling our money out of Fidelity's money market funds? Are they too expensive? Hello, members, super savers, and bond course fans. I hope you're healthy and well, and welcome back to our weekend update. It's been another week of ups and downs for markets, especially in light of the administration's back and forth on tariffs. Bond yields ended the week mostly up, but more on this shortly. Yields on some money market funds are a different story, though. And with that in mind, here are the three topics that we'll be covering in today's video. 1. Why are we pulling our money out of Fidelity's money market funds? And who might want to consider doing this and going to Vanguard instead? And in this section of today's video, I'll also give you this month's overview of what the top money market funds at Fidelity, Schwab, and Vanguard are paying right now. 2. Which treasuries rose the most and which ones fell this past week? And 3. What are the yield expectations for the upcoming week's 3, 10, and 30-year treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. Why are we pulling our money out of Fidelity's money market funds? And who might want to consider doing this and going to Vanguard instead? As customary, we'll be talking primarily about the government and treasury money market funds at these three leading brokerages, not prime or municipal money market funds, as government and treasury money market funds are where many of us park our uninvested cash, and also because government and treasury money market funds are most comparable to T-bills in terms of risk profile. Here's where Fidelity, Schwab, and Vanguard's top money market fund rates stand currently. And when I say rates, I'm referring to the 7-day SEC yield, a standardized method of calculating the yield on funds that is comparable across firms and products. And because the 7-day SEC yield is sometimes misunderstood, please do note that the 7-day SEC yield is based on the last 7 days' performance of a fund, hence the name. But this is then converted into an annualized rate net of expenses, but before taxes. So the 7-day SEC yield should give you a good indication of how an investment has been performing for you on an annualized basis after costs. So for Fidelity, we have SPAXX, Fidelity's Government Money Market Fund, at 4%. VMFXX, Fidelity's Treasury Money Market Fund, at 3.98%. And FDRXX, Fidelity's Government Cash Reserves, at 4.05%. All three of these are core money market funds at Fidelity, with FDRXX typically only available in certain tax-advantaged accounts, such as IRAs and HSAs. And as a reminder, a core money market fund is a type of money market mutual fund that can be used as a core position in an account, meaning that that is where your uninvested cash is automatically held. There's no need to place a buy or sell order for a core money market fund. I also need to give an honorable mention to FDLXX, Fidelity's Treasury-only money market fund. FDLXX is not a core money market fund, but I know quite a few of the Fidelity fans in our community who live in California, Connecticut, and New York park their uninvested cash there. FDLXX is at 3.91% at the time of this taping, after expenses of 42 basis points. For Schwab, we have SNVXX, Schwab's Government Money Fund, at 4.09%. SNOX, Schwab's Treasury Obligations Money Fund, at 4.08%. And SNSXX, Schwab's U.S. Treasury Money Fund, at 4%. Schwab does not offer any core money market funds anymore, meaning that you will have to place a buy or sell order every time to move your money into or out of their money market funds, including these three here. If you do not do this yourself, this is the APY that your uninvested cash in your Schwab brokerage account is earning right now, not these rates here. For Vanguard, we have VMRXX, Vanguard's Cash Reserves Federal Money Market Fund Admiral Shares, at 4.27%. VMFXX, Vanguard's Federal Money Market Fund, at 4.26%, which is also Vanguard's Core Money Market Fund. and VUSXX, Vanguard's Treasury Money Market Fund, at 4.26%. And what we can see here is that these money market fund rates at Vanguard, these 7-day SEC yields, are noticeably higher than those at Fidelity and Schwab. And the reason for this is because the expense ratios on Vanguard's money market funds are also noticeably lower than those on Fidelity's and Schwab's, which should come as no surprise to the Vanguard fans in our community, since Vanguard is well known in the industry for the low cost of their funds. There are also at least 3 important points to note about the money market funds and rates we've shown you here. First, if you're with another leading broker and that broker offers Vanguard money market funds on its platform, there is typically a minimum initial investment requirement of $3,000. Second, these Schwab funds here are what Schwab refers to as investor shares, which have a minimum initial investment of $0. Each of these funds also offers ultra shares, which typically have a rate that is 15 basis points higher than what is shown for the investor shares, which can be attributed to different expense ratios. However, the minimum investment for ultra shares is $1 million. Third, while the interest earned on T-bills is exempt from state and local taxes when held in a taxable brokerage account, tax treatment on dividends earned from these money market mutual funds can vary depending on the percentage of treasuries held as well as the state you live in. For more details on this and any of the money market funds here, please refer to these money market fund videos that I've linked below for reference. So, now that you know where Fidelity, Schwab, and Vanguard's top money market rates stand currently, it'll be much easier to understand why we're pulling our money out of Fidelity's money market funds. They're simply paying much less than all these shorter maturity T-bills. And the main reason is that the expense ratios on Fidelity's money market funds are some of the highest in the industry. Now, this is nothing new. Fidelity needs to make money somehow. And for them, money market funds seem to be one of the places where they can make a very nice big chunk of money. Let's just look at SPAXX alone. An expense ratio of 42 basis points multiplied by total SPAXX assets of $392 billion means Fidelity makes about $1.65 billion annually from SPAXX. Not too bad, for Fidelity at least. Like I said, it's no secret that Fidelity's money market funds have some of the highest expense ratios across the big 3 brokerage firms. But it has been bothering us a bit more recently as the amount of dry powder that we have in our Fidelity taxable brokerage accounts continues to accumulate against a backdrop of falling interest rates, market volatility, and economic uncertainty. And from the communications we've seen from some of you, it seems to be bothering you a bit more as well. So, in light of Fed Governor Jerome Powell's speech yesterday on the economic outlook at the University of Chicago Booth School of Business, where he stated that the FOMC does not need to be in a hurry to lower rates, that they are well positioned to wait for greater clarity. Meaning rates will probably continue to stay higher for longer. We decided to move the vast majority of our excess cash that was parked in Fidelity's money market funds back into 4-week T-bill ladders and keep these 40-plus basis points in our own pockets, so to speak. And all of our excess cash at Fidelity will be in T-bill ladders again by next week, basically, if it goes as planned. And our emergency money that we want to be able to access immediately, we've actually moved into Marcus's E-Trade account, where we can park it in VMFXX, because you can buy VMFXX at E-Trade, assuming you meet the minimum purchase requirement of $3,000. You can't buy VMFXX from Fidelity or Schwab. This way, we still have the flexibility to access our emergency cash at E-Trade on short notice if we need to, while earning 20 to 30 basis points more in the near future. And if a great buying opportunity does come up and I need the cash that's tied up in my T-bill ladder at Fidelity, I can always sell my 4-week T-bills. And I know some of you who are with Fidelity are considering doing something similar, because Vanguard's money market rates are some of the best in the industry. Plus, they've recently lowered the expense ratios on a number of their other funds as well, as we discussed in this recent Vanguard video. That said, if you do end up moving your cash from Fidelity to Vanguard or E-Trade to maximize the yield on VMFXX, do keep in mind that Vanguard and E-Trade have fewer bells and whistles and are a bit less user-friendly than Fidelity's platform. But if all you're doing is moving your excess Fidelity cash there to park in VMFXX, this may not matter all that much to you. What about you? Which money market fund is your favorite? Drop a comment below and let us know. Maybe we'll be able to include it in future videos. Now, let's move on to the next section of this video and talk about where T-bill, T-note, and T-bond rates ended the week. Which treasuries rose the most and which ones fell this past week? As we so often do at the end of the week, let's grab our rates from the Treasury's Daily Treasury Par Yield Curve Rates page and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. And here's the increase or decrease in rates over the past week. Increases in rates are shown in black, and decreases in rates are shown in red. Yields continued their roller coaster ride this week with all the tariff and economic uncertainty. At close of market on Friday, the 1.5-month, 2-month, 4-month, and 1-year were down. The 1-month and 2-year were unchanged. The 2-year did not manage to break above 4 again this week. All the other maturities ended higher and noticeably on the long end, as you can see here, with the 20 and 30-year up 11 basis points after Fed Governor Powell's speech that despite elevated levels of uncertainty, the U.S. economy continues to be in a good place, signaling that the FOMC can continue their wait-and-see approach regarding the next interest rate move. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd of this year. And this row shows the increase or decrease in rates in 2025 so far. Again, increases in rates are shown in black and decreases in rates are shown in red. The 6-month is the only treasury that is still slightly higher than where it started the year, just by 4 basis points though, to be precise. All the other maturities are down since the beginning of 2025, with the most significant downward moves to be seen on the 2 through 10-year maturities, and not by just a few basis points. Overall, the yield curve has steepened again, but only by a bit. As always, we'll keep watching these changes and keep all of you informed here on our channel if anything changes on this front. The inflation report next week will be another interesting one. You can find more details on these rates for any day of the week that the bond market is open on the Treasury Daily Treasury Par Yield Curve Rates page, as I mentioned earlier. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of today's video. What are the yield expectations for the upcoming week's 3, 10, and 30-year Treasury auctions? Plus, what are the highest yielding opportunities for new issue agencies, corporates, and brokered CDs right now? Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill auctions are happening as usual. The 3-year T-note, the 10-year T-note, and the 30-year T-bond will be auctioned off as well this upcoming week. The 10-year and the 30-year are reopening auctions, so we already know the coupon on those. At the time of this taping on Fidelity's platform, here's what the coupon and the expected yield are for the 3-year T-note auction. And here's what the coupon and the expected yield are for the 10-year T-note auction. And here's what the coupon and the expected yield are for the 30-year T-bond auction. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. So that was Treasuries. For agency bonds, the highest yielding new issue is from Federal Home Loan Banks at 6%, with a first call date in June 2025. Here's a CUSIP for those of you who may be interested. For corporate bonds, the list is very long this week on Fidelity, with the highest yielding, shortest maturing one from Jefferies Financial Group at 6%, with a first call date in March 2026. Here's a CUSIP for those of you who may be interested. For brokered CDs, the highest yielding one is again from Jonesboro State Bank at 4.6%, with a first call date in June 2025. As always, if you know of any bank CDs or checking and savings accounts with particularly attractive rates at the moment, then please do drop them below and let me and the community know. All right, members, super savers, and bond course fans, I hope you enjoy this video and learn something new. And as always, if you want to learn more about treasuries and bond investing, then check out this video here on our bond courses. Or come join our next live member Q&A on Sunday, March 23rd at 5 p.m. Eastern Time, 2 p.m. Pacific Time. We'll be diving deeper into this month's 2, 5, and 7-year treasury auctions and all things fixed income. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and or CDs this coming week. And see you again very soon with more brand new wealth building content for your financial journey.